Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So it's Friday, in front of a long weekend. Hopefully everyone has some great Labor Day plans. For us, it's just going to be a lot of family time, yard work, all that fun stuff. So today we're going to go through, obviously, the Primary Vision Frac Spread Count, but then we're going to go over some of the other key data sets that have come out and look around the world again in terms of OPEC, following up from the OPEC meeting. What are some of the impacts from Hurricane Ida? How has that gone through? And then some recent, we obviously had jobs data today, which were terrible. But for those that have watched the Econ show, that's not surprising. These are things that we were expecting to happen. To be fair, not to this level, but we thought it was going to be a bit light, but September was going to be worse, but it looks like it came in on this side. So before we get into the frac spread count, we just wanted to show this chart because I think it's important to highlight how important frac spreads are, especially when you're looking at production. So if you're looking to get as close as you can to production numbers, obviously rigs have a correlation. I'm not fighting that. It's just frac spreads get you much closer to that bullseye, get you much closer to the number. The correlations are very close on a 30, 60, and then by 90 days, we're spot on. But really 30, 60 day, very tight correlation. And one of the things that we wanted to call out, because we get calls often about the anomalies on how our numbers are wrong, is the February freeze off. So when you look at what happened in Texas, you can see that we started to see that downturn, and we came very close and we were really spot on when it came to where frac spreads went down, how quickly they came back up, what percentage they came back up at. And then you could see how it's correlated closely to, obviously, production, but there was production shutdowns, and then how things continue to rise up. It's also important to look at how the frac spreads have continued I'll call it meander, kind of around these levels, but as the rig counts continue to move up with another increase in rig counts, even though the top number is down, that's because of Ida, but we'll go through that in more detail. So without further ado, the Primary Vision frac spread count is 240. So we had zero adjustment week over week, but within the numbers, there were some shifts. So we did get some of the smaller basins take some work down, and then we did start to get an increase in activity in some of the basins that we've been highlighting on our insights, one of which is the Permian, but more importantly is on the natural gas side. So we did get increases in the Haynesville, which for those that have been following natural gas isn't overly surprising. In insights this past week, we looked at natural gas, where's the curve, where's storage, what is this going to look like going into shoulder season, and then obviously LNG. So just to give you some brief backdrop, when we look at storage, the only times we've had lower storage was 2014 and 2018. So when you think about those 2 years, you also have to consider where was LNG, how much natural gas was being consumed internally, and how much natural gas, by internally I mean residential, and then natural gas in terms of power gen. So when you look at coal retirements, when you look at natural gas in the home, in the office, and now, about anywhere from 5 to 6 MTPA or million tons per annum, essentially 6 MTPA per month of LNG, you're in a very different spot. So I think that you're going to continue to see this activity pick up in natural gas areas. Now, that typically happens on a seasonal level just because we're getting, guys are going to start looking to prepare for winter. But when you look at the curve, and we don't have it on here, we have it on our insights, you can see that there is a lot of strength essentially through 2023. Some re-rating possible, but as anybody who has ever traded natural gas, we've been here before, we've had bullish setups into winter, and then we've had a really warm winter. So there's a lot of shifts that can happen, but winter so far, and again, it's September, winter weather can change. It should be a bit colder. The benefits or some of the positive tailwinds that we still have is Europe is still very short. Asia is still short. Russia is struggling to fill their levels of storage in terms of where is storage going to go. Is Russia going to send it to Western Europe? Are they going to try to keep it within the country to make sure that they have enough natural gas for winter? So when you just look at the backdrop, even if we have something a bit warmer or the winter starts out warmer, there's still a lot of this backdrop where a lot of demand can continue to flow abroad, which will put a, just looking at LNG coming from the U.S., that's going to be a fairly steady flow as we go through the shoulder season and into the winter months, putting, hopefully a little bit of a difference versus those that are beaten gas bulls, such as myself, when we look at the LNG trade. The LNG trade, not to tout myself too much, but the LNG trade, I called it perfectly, but for those that know, to call something perfectly, especially when you look at natural gas and LNG, there's a lot of pain along the way, especially when you're looking at how some of these stocks have moved. You've been punished on the P&L side. So it's a lot of management of risk, just to make sure that you can have your thesis play out. But it's enough on natural gas as we go forward. So now when we look at things that are happening in the U.S. right now, when we look at rig counts, in total, you can look at the total was down 6. But land was up 5. So I think that's the bigger one to look at this point, with obviously offshore down 13, with Gulf of Mexico down 14. So when we look at horizontal was up 4 and vertical was up 2, and the directional was that 17 side, with pretty much all of that being because of Ida. So where do we lose? Obviously the Gulf of Mexico, everyone left, walked away, locked everything down, make sure that everyone was safe for the hurricane. Then obviously Louisiana had to lay down rigs because there's a storm coming through. So as that starts to come back up, so we did get an increase of 5 in gas rigs. That's something that when you look at gas rigs going up, we think gas rigs will continue to get added, but we will see more frac spreads also coming and getting active. Some in the Northeast, but really not as much as in the Marcellus and Utica. It's really going to be a lot of not only just Haynesville, but also parts of Oklahoma. Now that brings us, as we talk about Hurricane Ida, U.S. Gulf shuts 1.7 million still of oil production. So there's been a struggle to get some of this back. That's going to continue. A little bit of gas has come back, not much. There's still about 2 BCF, just under 2 BCF a day offline. But when we look at what's to come, you have to see that there's 1.7 million that's still offline. So that's production not coming to market. The U.S., so far, we've picked up an extra 6 shipments of crude coming into the U.S. That brings us to 22, which is the highest level that we've had since June 6th, I believe, or June 4th, or at least the first week of June. So we do have a big increase of flow coming from the international markets into the U.S. markets. That's going to help supplement some of this. As we talked about on Twitter, there's a 1.5 million barrel release from the SPR, again, dropping the bucket. But still something to in terms of a swap. Right now there's by the time the weekend ends, we should have about 1 million barrels a day of refining capacity back online. It's just going to be, when does power come back? When can people get there, test the equipment? Because when you bring a refinery back on, you have to do it in stages, and you have to do it slow because you want to make sure, and you have to go through your checks and balances to make sure that nothing is going to backfire. So again, there's a very steady process, but that takes time, just as it does for the production side. So in terms of marriage in general, we should still see a build in crude, just as the refiners still haven't come on. But depending on when some of this capacity offshore, that'll offset. But what we're looking at right now, we'll get offshore capacity coming back at a very similar time when a lot of these shipments show up. So will some of this get resold back into the market in terms of a reoffer, or are we just going to get some outsized builds when you get that marriage of offshore imports and then what's coming in from the offshore markets in general? And a bit of house news. So Chevron is looking to sell its oil and gas assets in the Eagle Ford Basin, which, obviously in South Texas. They're looking for as much as $3.8 billion, just to give you an idea of, some of the things that are currently for sale as some of these majors rejigger their portfolios. Now, for those that saw the OPEC Plus meeting and experienced the fun that we had during July 4th, this one was the complete opposite of that. Everything was pretty much exactly as we were expecting. everything was consistent through October. Nothing really has changed. This is the new update for the amount of production for October. So again, still seeing that steady increase of 400,000 barrels a day spread across these different countries. The next meeting is October 4th. That's where we think that they're going to start talking about what are some of the restrictions that we could see as we go through into November and December, because when you look at balances, especially when you look at demand, look at supply, there's some concern starting to arise on 2022. So we think those conversations will begin in October, where then that's really going to impact what's production going to look like in November and December. We don't think there's there's not going to be an all-out pause, but there's a good chance that you could see a slowdown where instead of it being 400, it's 200, 250, and you're going to start to see those negotiations. Russia continues to produce 100,000 barrels over their allotment. And now all of this is happening at the same time where combined oil exports in West Africa fell to the lowest level since 2013 in August. And yet we still can't clear. And that's some of the problems that we continue to see when you look at the physical market. October, as we talked about, nothing is improved for Nigeria in October sales. There's still a lot of floating storage, which is something that we've been talking about when we look at floating storage versus onshore storage, which again keeps us concerned about what that physical and forward physical market is telling us. And now people are starting to see some of the same things when you look at discussions on 2022 builds. So when we start looking at a bit more specific to products, so Singapore, total stocks were flat, but when you look at the underlying side of it, as we've been talking about, we expect to see builds in middle and light distillate with some drawdowns of resid as you start to see some of these balances. And the shift from resid to middle was pretty apparent. And this is what we were talking about of how much of it is going to be exported into the Atlantic Basin and into Pad 5, and then how much of it is going to end up in storage. And we were like, look, it's going to be 50-50, maybe 60 into the export market, 40% into the storage market. And that's what we're starting to see here. While we're waiting for stuff to show up within Europe, you can see that it is still slow to get there. You can still see the some steady draws, which again is still strong for European refiners. We did get Urals get bid up, or I should say offered higher. We still haven't seen any crossing, but again, it's going to be a matter of, as we've been talking about at the beginning of the month, we've seen companies put these big, say, all right, let's test the market and start out at $1.80 below dated Brent, and then slowly work its way back down to where we were, previously. So those are things that we're going to have to look for. So far, it's playing out the same way. We want to see where the barrels actually cross, not where they're being offered. And so far, they would like $1.80 below dated Brent, but it's unlikely that we'll get there. But again, these are things that we're going to continue to watch and look for. Now, on the Chinese front, you can see that teapots continued to see some activity come back. But at the same time, we see state-run refiners still running at fairly low rates. So the question is going to be how much of that is going to convert over from teapots into state-owned. So far, there hasn't been too much shift, but the state-owned guys continue to struggle, or at least not really move at these levels. And even though we see this increase in rates at the teapot side, when we look at Shandong, we still have crude at near all-time highs, very little change. And this is concerning because when you look onshore, then you look offshore. Offshore still has a lot of crude sitting there. China has taken down again some of their imports. They're still slow to purchase. Again, looking to Nigeria with some of the and West Africa in general, some of these reoffers. A lot of that is some of this Chinese purchases getting pushed back into the market. Then when we look at products, here you can see Shandong fuel oil products. Not a very good situation when we look at what are some of these products. This is looking at fuel oil. And just, again, we're continuing to see these builds on the fuel oil side, which is a bit concerning. And then when we turn abroad and we look at some of these opportunities, it's just going to be, where is this crude going to get redirected? But one of the benefits, and this is as we talked about in segment 5 of the Econ show, we've been very bearish on China and Asia in general, and we still remain bearish on China, but things have gotten a bit better, and I think you're seeing it play out here, getting close to normal when you look at traffic levels. It's not quite there. There's a little bit of a softness in general, not softness in the sense where it's still at 80%. But, just below 100, you're still seeing some of this competition. But then when we look at Europe, rest of Asia, North America, or Americas in general, you can see things kind of settling out. But then when we look at gas buddy data, so Wednesday demand was down 7.2% from last Wednesday, and 7% below the last 4 Wednesdays, with Thursday being down 3.1% or 3.5% below the last 4 Thursdays. So you still had impacts of Ida as it went through essentially most and flooded large parts of the Northeast. So that you do have some of that hurricane impact, but you also have, again, as we've been talking about, the difference between July 4th and Labor Day. We're going to be vast, and we continue to see some of this seasonality play out. So now when we start and we turn to some of the U.S. data that came out, here's where, when you look at change in private payrolls, or I should say non-farm payrolls, was 733,000 was the estimate, came in at 235,000. As we said on our econ show, it was something closer to 500. And that's just looking at what PMIs have said, what local Fed data has said, what the bigger PMIs have said on a national level. We saw that contraction in employment. We talked about it in segments 2 and 3 of yesterday. And it just played out. We thought this type of drop was going to happen in September. Instead, it happened in August, and we think this pressure continues into September, even though you have the expiration of the extended benefits on September 6th. On the other side, an unemployment rate stayed fairly flat. Not too much has changed. Average hourly earnings month over month were up. Again, we talked about that again yesterday. A lot of that is being driven with that bottom quintile, which is, again, still a positive, but it's just something to consider as we look forward into what is going to come next, as the underemployment rate also got better as people were finding jobs that they deemed something closer to, or at least full time. On the service PMI side, things were fairly in line with expectations at 55.2, came in at 55.1, which put the composite at about 55.4. And then services continued to be robust with the estimate of 61.6, came in at 61.7. That's still a move down from the prior, but again, still strong, still expansionary. So we have to look at what does that mean for the U.S. going forward, which is then when we look at the Chinese data. China had a big miss last night. So the manufacturing PMI, as we talked about, was just negative, or the CACS, I should say, was expected at 50.1, came in at 49.2. But the composite came at 47.2 because PMI services missed by such a wide margin. So the expectation was for 52, came in at 46.7. That is way below. We're bearish China, and that was below what we were expecting. August, and the reason why is because August did finish better than how it started, and that's because things were reopening again. COVID was on the other side. So we do think that you get some growth back in September. Again, it'll be marginal growth, but it'll still be above 50. And it's just like, this is just showing but how weak some of the things are. But it also points to the pressure that's going to continue when we look at what's happening in the U.S., what's happening in the global market, given the softness that's happening in China. And then Japan had something similar where Japan PMI services came in at 42.9, which was down from the prior 43.5, and PMI composite was at 45.5, down from 45.9. Now, the problem was the estimates were, just again, a little bit higher. This is another one where we see Japan picking up a bit and starting to get back to, again, not growth. So in China, we expect it to be back above 50. In Japan, we still believe it'll be below 50, or, in contractionary, just close to that 47, 48 as we go into through the end of September. And here's just looking at the global composite. And this is what we're talking about when we look at U.S. GDP, U.S. growth. You know, we look at the Atlanta GDP estimates has been taken pretty far down from about 5% to about 3.3%. And it's just when you look at a lot of these leading indicators, you're starting to see some of the softness. So the global economic expansion slowed to a 7-month low in August with the global PMI at 52.6. which was 55.8 in July. So slower growth was recorded across both manufacturing and services, way more in services than manufacturing. And at the same time, we were talking about, again, that slowdown on the employment is not just in the U.S., but also in the global backdrop. So then when we turn to China, to Japan, here's where you can see that pretty steep slowdown. The service sector contracted, and it's just, again, services remains the biggest problem, and this is showing household service expenditures, activity. It's this retail sales that just isn't really there on the Asian side, which again brings us to the reason why dual circulation strategy, you know, the common prosperity becomes this bigger focus, especially in China. But these are the headwinds that we continue to see. Now, when we break down some of the numbers here, you know, this is that GDP now, when we look at the Atlanta Fed expectations, is down to 3.7%. Some have it down to 3.2%. This is just looking at the kind of that big marked drop, and that's really driven based on what estimates are and then what actuals, as we talked yesterday about the city surprise index and how that continues to draw things down. So then when we dig into the payroll data, here's where you can see things leveling off. And as we've been talking about, we're going to get that big check mark, you know, that 50%, and then really start to flatline. So here, when we look at some of the backdrops, the wages, again, were up that 0.6%, but job losses versus February of 2020 were still 5.3 million below. We've regained about 76%. But when you look at the pre-COVID path, you know, the path continues to trend up, which is, again, as things continue, makes things a bit slower, if you will, to get to close that gap. And as we progress through seasonally tougher periods for hiring, that's going to put some of these headwinds as well. And then when you look at the total number of 147.1, you get the idea of kind of where things sit and how we've seen some of the slowdown, and I think you're going to see some of that seasonality, factor in. Then when we turn to the hourly wages, here you can see average hourly earnings 4.3% year over year versus that 3.9% estimate and the 4.1% from the prior month. So you're still getting that steady move. But when you look at what Walmart has said, what a lot of these companies have said, it's really that lowest hanging fruit, as this is the highest wages or the biggest increase in wages we've seen for restaurants and supermarkets ever. So again, you're seeing where it's coming from, and it's at that bottom end. That it's not a huge number into discretionary spending, but it's still something that is supportive in general. Now, one of the really positive sides here for the big drop in permanent job losses. So you can see that a lot of people that have been sitting on the sidelines starting to really push their way back in, and that's when one of the key pieces of, again, that drop off of long-term unemployment, the pandemic benefits, which officially expire for everyone else September 6th. Again, driving people back into work, with permanent job losses down to 2.4, almost 2.5 million, and the number of unemployed on temporary layoff down to, again, that 1.25. You see that tick up a little bit and flatline, and the temporary side, that comes down to some of those assembly lines slowing down that we've been talking about, that we've seen in some of the regional data that we talked about yesterday. That's where that temporary layoff is still getting some of that bid, or at least some of that stability, which should start to come down as supply chains catch up a bit. You start to get some of these things turning back on as we come into some of that peak demand period, as everyone prepares for the holiday season. So I know we covered a decent amount, a little bit of everything. If you have any questions, obviously we love the comments. You can find me on Twitter or on email. So again, we hope you have a great long weekend and a great Labor Day. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.